Hello there, econ friends. Welcome back. In this final video, what we're going to do is continue our discussion of money, the money system, and monetary policy. And we're going to focus specifically in this lecture on central banks, which here in the US is known as the Fed, or the Federal Reserve System. So we'll talk about central banks, and we'll talk about the role that central banks have in monetary policy. Okay, let's jump into it. By straight definition, a country's central bank is an institution that determines the quantity of fiat money in circulation. We learned earlier that fiat money is that form of money that is not backed up with any type of commodity basis. Fiat money is the main component of it, is really for most modern economies the money supply. So a country's central bank is an institution that determines the quantity of fiat money in circulation. In other words, the central bank controls a nation's money supply. Okay. This is going to make it very important because fundamentally monetary policy, as we'll learn shortly, is all about changing the money supply to then have a corresponding change on interest rates. I'm going to go to blue here for the color. In many countries, in addition to their role in controlling the money supply, many central banks also regulate the banking system. Now, it's important to note that even though you hear the term central bank, this is not a traditional bank. You as an individual citizen cannot go in and start an account and take a loan. Rather, it's best to think of a central bank as a banker's bank. You can think of a central bank as a banker's bank. So while it is not a traditional bank that provides services to the public, it is a banker's bank that does provide important services to commercial banks. Those services include acting as a lender of the last resort. Central banks can oftentimes take a bank's excess reserves, which we've spoken about, and a bank can park their excess reserves safely at the Fed, and the Fed will pay interest to them. If a commercial bank has some liquidity issues or needs to raise short-term cash, they can borrow money from the central bank. So again, the central bank is not a traditional bank like Bank of America or Chase that you and I can walk into for services, but rather it's a banker's bank. It provides really valuable services to commercial banks. It also regulates the banking system, and critically, it will control the money supply. Now, most modern industrial countries have their own central bank. Here in the US, ours is formally called the Federal Reserve System. So that's the name, the formal name of America's central bank. It is the Federal Reserve System. But it's commonly shortened to simply the Fed. When you're watching the news and you hear about the Fed did this or the Fed chair said that, they're referring to the Federal Reserve System, America's central bank. And chances are that news story that you're watching is going to be talking about some kind of policy decision that the Fed made with the intention of either changing banking regulations, but more likely affecting the money supply, okay? Now, the Fed has a pretty straightforward structure, and if you look in your textbook, it really breaks it down. But critical for our purposes today is to understand that the Fed has a handful of committees. And of all those committees, the most powerful one is known as the Federal Open Market Committee, abbreviated to the FOMC. The Fed's Federal Open Market Committee, the FOMC, is a very powerful committee that determines the Fed's policy with the respect to the purchase and sale of government bonds and other financial assets. So the Fed does a lot of things, but the real meat of their power lies with the FOMC, the Federal Open Market Committee, which determines the Fed's policy with respect to the purchase and sale, the buying and selling of both government bonds and other financial assets in the economy. Okay. In this way, when you think of the FOMC, these FOMC operations, and again, the term operations refers broadly to both the buying and selling of government bonds and financial assets done by the Fed. Okay, so the Fed will buy and will sell, depending on what it wants to achieve, government bonds and other financial assets. Collectively, those purchases and sales are known as open market operations. Okay, and in this way, these FOMC operations are the primary way that the Fed controls the money supply in our country. And therefore, it is through FOMC operations and through the control of the money supply that the Fed or any other country's central bank forms the basis for monetary policy. And that, my friends, leads us to our last big discussion point in this series, monetary policy. Now, before we jump into this, I want to kind of trace the evolution of what we've been doing in our macro time. We started off by talking about macro measurements, and then we jumped into the business cycle. And we know that there's some ups and downs in the economy, and that each of those periods, the expansions as well as the contractions, may be associated with some bad economic conditions. Okay, we discussed those. We discussed inflation. We discussed unemployment. We know how to measure them. Okay, we know that what happens when economic growth stumbles and we contract the economy. So we started off by talking about those. We then moved into talking about economic growth and why it's important. And obviously, a part of economic growth in the short run is trying to minimize those big fluctuations of up and down in the business cycle. At this point now, when we move into monetary policy, we're shifting our focus into the idea of policy. Given the fluctuations that the economy can face in both the short run and the long run, and given how these fluctuations can affect unemployment and inflation, these other big metrics, macroeconomics has a couple of questions, one of which is, what policies can we implement to try to fix these problems, try to keep the economy on course, to try to correct any major fluctuations and economic, either bad inflation or bad unemployment. So we're moving now into a discussion of some of the policies that we can do to maintain economic stability. This is monetary policy. Our next topic in our next set of videos will cover another one that's known as fiscal policy. And then at the end of our macro time, I'll teach you a model known as the ADAS model that'll bring all this stuff together into kind of a big unified picture. Okay, so in terms of context, we're moving now out of the discussion of the problems and into the mechanics of the policies to help address them. And our first one is monetary policy, which we would define as efforts by a central bank to change the money supply and in turn change interest rates. So at its core, monetary policy refers to efforts by a central bank to change the money supply and change interest rates, generally with the goal of either influencing growth or employment or inflation. Okay. Now, keep in mind the big picture from our last set of videos, which is that interest rates, because they're the price of money, they serve as strong incentives for economic behavior, specifically for the consumption of consumers, which we know is C, and the consumption of firms, which we know is I. And again, you'll remember that basically C plus I plus G plus X minus M, that's the components of our output. That's our GDP components. C and I are by far the biggest, okay? When we take a look at monetary policy, it's best to start off with a very, very simple look at how money supply works at the national level. You see here that we have another market. This is the market for money. You will notice in this case that the money supply curve is perfectly vertical, perfectly up and down, because it's fixed. Since it's fixed, the supply is perfectly vertical. So the money supply is a vertical curve because the money supply is fixed. And it is fixed by the central bank. On the other hand, money demand, traditionally, like any demand curve, downward sloping. The key to this, again, is where money supply hits money demand, you have your equilibrium interest rate. You come over here, and there you go, your interest rate. And we know that this is important because the interest rate is a major incentive for both firms and households, okay? Monetary policy, by definition, is going to be moving that money supply curve by either expanding the money supply or by contracting the money supply. And whenever you change the money supply and shift that supply curve, by definition, you're going to change the equilibrium and affect the equilibrium price, aka the interest rate. Let's break it down, reduce this a little bit. We have two basic types of monetary policy. Number one, an expansionary monetary policy. An expansionary monetary policy, which is also known as like loose money or cheap money or easy money, for reasons that you'll see, an expansionary monetary policy increases the nation's money supply. And as a result, it decreases short-term interest rates, thus boosting aggregate demand and employment. So the chain of events says this: expansionary monetary policy will lead to lower interest rates, and that will lead to more spending on consumption and more spending on investment, which will basically increase output and GDP in the economy. Okay, that's expansionary monetary policy. On the other hand, the second type is known as contractionary monetary policy. This is also known as tight money or hard money, okay? In a contractionary monetary policy, the central bank decreases the money supply. And as a result of that, they are increasing short-run interest rates. So contractionary monetary policy reduces the money supply, thereby increasing interest rates, and therefore reducing overall aggregate demand. That's going to reduce consumption, and it's going to reduce investment because higher interest rates make it more costly to borrow to finance these purchases, okay? You can see this all right here. If you take a look here, we're going to start off in red, money supply 1, money demand, equilibrium, okay? And here's our equilibrium initial interest rate. We're going to have some tight money. We're going to have a contractionary money supply. This is going to shift the money supply in. At this new money supply, we're going to have a new equilibrium, and that's going to correspond to a new and higher equilibrium interest rate. So contractionary monetary policy is going to shift our money supply curve to the left. It's still going to stay vertical. It's going to raise interest rates, reduce economic activity. On the other hand, we have here an expansionary monetary policy. Okay, we have some easy money. Once again, we're going to start here at money supply 1 and money demand. We're going to have our equilibrium interest rate, our price. In this case, we're going to have expansionary monetary policy. So the money supply is going to expand and shift to the right. This will give us a new equilibrium. And you're going to see here that we're going to have a decline in interest rates in the short run. Okay, so this is the mechanics of it. In terms of when it's done, if we go back to our business cycle diagram that we learned earlier, you get a bit of a clue. Remember that we have 4 basic phases. contraction to peak, recession to trough. But ultimately, we have periods where you have expansions, and those are going to lead at times toward their end to some inflationary pressures. And then you're going to have recessions where the economy is underproducing, and those are going to lead to some unemployment pressures. Okay? So again, we have our business cycle. We have our phases, expansionary phases to contractionary to expansionary, and you get the idea. Okay? Whenever the economy is in an expansionary phase, over time, it's going to build up some pressure for inflation. This is going to tie back to what we learned about in unemployment. Whenever you have actual output exceeding potential output. So note that we're going to wrap into this discussion our idea of full employment output, or the full employment natural rate of unemployment that we discussed before. Okay, but whenever you have this situation, typically toward the ends of expansionary periods, you're going to get some inflationary pressures. Whenever that happens, the government will consider contractionary policies. Those contractionary policies will raise interest rates, which will reduce consumption and investment, which will sort of bring down our GDP number and get us from being too high to getting us down to where we want to be. Of course, there's a trade-off here, because with the contractionary policies, the economy will start to potentially contract down. And when that happens, if it goes too far, we get down here in this area where we're underproducing, where we can be in recession. When, to see it a different way, the economy's actual output falls short of potential output. We're not producing enough. And that's going to be a recessionary gap, and that's going to lead to unemployment. And when that happens, when we have these recessionary gaps, this unemployment problem, we will put together expansionary policies to drop those interest rates down and to encourage more consumption and more investment. Okay? So that's the way that it works right there. When we talk about this, we see that the big picture is around interest rates as a way to counter the booms and busts of an economic cycle. We know that interest rates are influenced in large part by money supply, and we know that the Fed is the one that controls it. So we'll wrap this up by thinking through how can the Fed use its toolkit to influence the money supply, okay? And I will argue to you, my friends, that the Fed has 4 major tools that it can use to control the money supply. Again, the Fed has 4 tools. To expand this out to what it means, the Fed can deploy these 4 tools to either expand the money supply when they want expansionary policy to lower interest rates to kind of pick up the economy, or they can use this for contractionary monetary policy when they want to reduce the money supply to raise interest rates to kind of slow down an overheating inflationary economy, okay? And of course, there's trade-offs. So what are these 4 tools? Well, the first one is setting the reserve requirement ratio. We already covered this, and we know that the reserve requirement ratio, the RRR, is going to influence the money multiplier, which means that it will influence the amount of money that can be created, supplied, the monetary base number, anytime new money is put into the system. Okay, we learned that in our last set of videos. We have fractional banking, so $1 put into the system can generate more than $1 of new money. Given that, the Fed can set the reserve ratio. If the Fed increases reserve requirements by raising the required reserve ratio, that will reduce the supply of money. And that makes sense, because if you raise the reserve ratio, you're going to reduce the multiplier, so every new dollar of money deposited will create less overall money. On the other hand, if you decrease the reserve requirement, if you reduce the required reserve ratio, you're going to have a bigger money multiplier, and as a result, you will increase the money supply. So we have one big tool That is the use of the required reserve ratio as it affects the multiplier to either be able to create more money or less money based on new deposits. The second tool, the Fed can engage through the FOMC in what we call open market operations. Open market operations are the sale or purchase of government bonds. Sale or purchase of government bonds by the Fed in order to control the size of the monetary base. Okay? We have two different things. We have open market purchases and sales. In an open market purchase, the Fed will just create money out of thin air. The Fed creates money, and they use that money to buy bonds on Wall Street. The Fed effectively buys bonds and takes bonds out of the system, but injects money into the system, okay? When the Fed buys things, including bonds, it injects new money into the economy, which increases the money supply. The opposite also holds true. In an open market sale, the Fed will sell bonds on Wall Street. So they'll put bonds into the system, but they'll pull cash out of the system. They'll pull back some of that monetary base. When the Fed sells some of its current holdings of government bonds, it's going to reduce the money supply. Because remember, the M1 and M2 money supplies, the monetary base, they include cash in circulation, but do not include government bonds. So when the Fed can buy bonds and inject new money in, the money supply grows. When the Fed sells bonds, it's going to, when the Fed sells bonds, it's going to put bonds in circulation, pull money out, reduce the money supply. When the Fed buys bonds, it's going to pull bonds out, inject money in, and increase the money supply, okay? You can see that summarized right here in a quick chart. Panel A shows the flows with open market purchases that increase the money supply, and panel B shows open market sales. The third tool, the Fed can set the discount rate. The discount rate refers to the interest rate charged by the Fed on short-term loans to banks. Basically, whenever a commercial bank needs money, it can turn to the Fed for a quick loan. The Fed can increase the monetary base by lowering the discount rate, and the Fed can decrease the monetary base by raising the discount rate. Again, by changing the discount rate, the Fed changes the incentives for banks to take out short-term loans for liquidity. This will affect the amount of loanable funds and deposits that banks have, and therefore the money supply. And the final tool that the Fed has, tool number 4, changing the interest rate that it pays banks on their reserves. You know that banks can have excess reserves. Banks can either hold their excess reserves at the Fed. They can also loan them out. But commercial banks, they can hold their excess reserves at the Fed, and if they do that, the Fed will pay them interest, just like you get interest when you put your money in the bank, okay? So if the Fed lowers the interest rate that it pays a bank on their reserves, it's basically going to encourage banks to reduce their excess reserves and therefore to extend more loans, and that will expand the money supply. Think about the incentives here. However, if the Fed raises the interest rate that it pays on excess reserves, that incentivizes the banks to hold excess reserves and not make as many loans. They're going to make good money from the Fed, so why take the risk of a loan? They're going to hold those excess reserves at the Fed. They're going to extend fewer loans, and that will lead to them reducing the money supply. So we have 4 tools, my friends, that the Fed can utilize. FMOC operations are the biggest, but we have 4 that allow the Fed to affect the money supply. This is either expansionary or contractionary, which in turn will allow the Fed to increase or decrease the interest rate. That's monetary policy. And that's one of the tools that we have to stabilize the economy. Thanks for this, and I'll see you next time.